Hello, everybody. This is Toni Turner, and welcome to the market now as of Friday, December 23rd at 11:30 a.m. Eastern. Before we start, please know that all of us at ToniTurner.com wish you and your loved ones happy holidays, Merry Christmas, a happy, healthy, and certainly profitable new year. Well, on to the market. Wall Street's main indexes opened lower in choppy trading today, and they've continued to go lower after data showed inflation cooled further in November, but not enough to discourage Federal Reserve from driving interest rates to higher levels next year. Oh boy. And on that note, let's go on to three charts that could give us some insight into the week to come. As we always do, we're first going to go to a daily chart of the S&P 500 SPDR, symbol SPY. As you all know, this is the ETF that tracks our S&P 500 index. And as traders and hopefully as investors, we use the S&P 500 as its direction as sort of a guide, because certainly many stocks will follow this, at least the general direction, all year long. So when I captured the chart today, as you can see down here, it's trading at $381.94, or about $38.19 on the S&P 500 itself. It is now 20% below the SPY's all-time closing high, which you can't see on this chart. It took place on January 3rd of this year at $477.55. So we are now 20% below that all-time high, so that means we're sitting right on the brink of bear market territory. When an asset goes below 20% or more below its all-time high, then it's considered to be in bear market territory. So we're just on the brink of that right now. As you can see, this past Wednesday, the SPY tried to pop up and move over the green line. Now, the green line here is the 50-day moving average, a major moving average, intermediate term moving average, we call it. The red line is the 20-day simple moving average. This is a short-term indicator. And of course, above we have the mighty 200-day moving average, which can be and has been this year very onerous, very powerful. It's caused a lot of resistance. Actually, the SPY hasn't traded above for any length of time, maybe a day or two here and there, but has not traded above the 200-day moving average since last March. So as you can see now, and you know, in the last couple of weeks, the SPY gapped up in the middle of December, and we thought, oh good, this means we can go higher, but it gapped up at the open, fell back down, closed at the 200-day moving average, because we've been watching this line for a long time, then continued to fall, did a real dumpster dive here, down to below 380. Now we have 380 as a price support right now, and again, the SPY is trading at 381.94. So this 380 is a price support. We're back down below the 50-day, the 20-day, the 200-day, and we have 380 here as price support. Then and 377. Then you go down here to 368. That's our next level of price support. And then, of course, we have where the October low, October 13th, nearly everything gapped down, and most things rose back up. So our low here in October is at 348. So this is our line in the sand right here. We have these other support areas. And so what we can do here, if we're bullish, if we want to be bullish, then fingers crossed in the upcoming week, the SPY climbs back above the 50-day moving average. That will help me get a little tiny bit more bullish. And then if we get really good buying coming in, it could, of course, run up and over the 200-day. But let me tell you, not to be negative in any way, but I believe there's a lot of shorts or people who sell shorts who may be, every time the SPY jumps up, they may be they may be going against that trade. They may be coming in and selling it short. So I don't think that the move up past the 50 and certainly past the 200 is going to be an easy thing to do. So please don't assume anything. Please don't assume, oh, well, okay, that's the bottom. The market's down. We're going up this year. Please don't assume that right now. I mean, certainly if you want to trade, please put in hard stops with your broker. But we need to give this a little more time to see which way it's going to go, because right now we're in kind of no man's land. Okay, our next chart today is the Invesco QQQ, symbol QQQ. Of course, this represents the NASDAQ 100, a major index in the market with top holdings including the big momentum stocks. We're talking Apple, Amazon, Microsoft, Facebook, Tesla, Meta, that whole group. Now, you can't see it on this chart, but the QQQ made its all-time closing high on November 19th of last year at $403.99. And today, when I captured this chart, the Q's was trading at $266.56. This is 34% below that all-time closing high. So we are definitely in bear market territory here. The techs are. And let me just tell you quickly, if you don't know this already, higher interest rates are very, very difficult on tech stocks. Higher interest rates are very hard on tech stocks. So I won't take the time to explain that here, but just know when you see interest rates going higher, that pressures tech stocks many times to go lower for a number of reasons. So what we can see here is that on October 13, the QQQ gapped down to $255. Then it jumped higher, and it did move back up to about 280, fell back down, then started moving up, finally got back above its 20 and 50-day moving average. Then it kind of sidestepped all the way through November, kind of in a range here. And we kind of thought, oh, good, maybe this is a shallow double bottom, maybe. But we didn't say it was, because it wasn't when we talked about it 2 weeks ago. And we said, well, if this happens and it sidesteps, then breaks out, then maybe, just maybe, the Qs get more bullish. It took a swipe. It did take a swipe at the 200-day moving average on December 13th. It gapped open here to $296.55. And but that was all she wrote. And then price fell right back down. Then again, took that dumpster dive down through the 20-day, the 50-day. Oh boy. And down to where we are today at $266.56, again 34% below our all-time high. Now we know that by looking at prior charts, I should say long-term charts, we know that we have long-term support here at 260. Fingers crossed that holds if price starts lower. And we also know that we have this low from October at 255. So these are the next two support lines that we have. Again, fingers crossed that it stays above them. Again, for me, it's a little early to start going bottom fishing. There are some alternatives to that, but you don't want to be catching a falling knife here. We want to see what happens going into next week, and then certainly the first of the year. Sometimes the sidelines can be the very, very best place to be. Remember, we always say cash is a position. So going into these momentum stocks when they're falling so hard is a game that's very hard to play sometimes and come out victorious. So please, if you do, please use hard stops. Okay, our final chart here is a daily chart of the Global X Silver Miners ETF. Symbol SIL. As we know, commodities, and that goes from agricultural commodities to industrial commodities and so forth, usually trade differently than the S&P 500, than the NASDAQ. They have their own way of doing things. They're not necessarily connected to the broader markets. So in looking through some of these, and right now, again, I really firmly believe that the best place is probably the sidelines, but this is a potential trade that, if it works out perfectly, may be okay. So what we're looking at here again is a daily chart of the Global X Silver Miners ETF, the SIL. It has 37 holdings, including Wheaton Precious Metals, Pan American Silver, Hecla Mining. These are all pretty well-known companies. This is a global ETF. When I captured this chart today, the SIL was trading at $28.80. It's trading, as you can see here, just above the 20-day and the 200-day moving averages. Now, that doesn't mean that it has to stay that way, but it's certainly a little bit more positive than many other charts that we've seen right now. Now, recent high that I looked at, and you of course can't see it on this chart, I just wanted to give you kind of a fix here, the November 2021 price that the SIL was trading at. Oh, November 2021, the SIL was trading at $41. So you can kind of tell it was much harder a year ago, a little over a year ago. Then you can see that it gradually fell, and we can see how the SIL fell even from a little earlier than that, all the way down to this year's low on September, where are we, right here, to this year's low on September 26th at $21. Excuse me, that's what I was looking for. It fell to this low on September 26th at $21. Then it rallied up in October to $26 right here. Then it pulled back to the 20-day and the 50-day moving average, sat there for a little while, and then started up higher, pulled back for a day or two, but managed to stay pretty much above the 50 and 20-day moving average. Then rose in November, consolidated again, and then finally the 200-day came down overhead, and price managed to stay up above this and walk kind of up that 20-day moving average until the first part of this week. Then it rallied back up again. What's kind of interesting to me here are these volume spikes right here. Volume spikes can tell a story. A lot of people don't bother to look at them, but I look at them intently because they can tell a story here. And so this ETF is not usually a high volume ETF. It still moves fine, and it is orderly, which I want to always see. But when I see high volume coming in, yeah, price dipped a little bit, but it rallied right back up, which tells you there are buyers here. So it is trading again just above the 20-day, the 200-day, the 50-day. If it can stay here, if in the coming week the SIL can remain above the 50-day moving average, which is now coming in at $26.99. Okay, this is the 50-day moving average right here. If it can stay above the 50-day moving average, I will add a small position to my trading portfolio, and my initial stop is going to be right under the 50-day at $26.50. If and when the SIL rises above these highs here at 30, I will add more shares to my position. So, and of course, by then my stop will be a trailing stop. So you may want to keep an eye on the SIL in the coming week. Finally, please know that if you'd like to become a more successful trader, please check out my trader training programs. You can choose from 10 different online trainings, like our flagship training, 7 Steps to Successful Trading. Everybody likes this. You learn so much from it. And my easy-to-learn strategies targeted to swing trading, trend trading, which is great to know, especially right now, bottom fishing, which is going to be so important and is important right now. To start out the new year by learning how to increase your gains quickly and easily will be a good thing to do. So see all of my online training programs. Just go to the link on this screen or simply click on the orange button below. Again, happy holidays to you and your loved ones. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.